Hello there, welcome to this edition of Global Business Africa. It's the last program of the week, so we have a fairly comprehensive wrap of all the key business stories you need to know about today and over the long term. From Cairo, Johannesburg, Nairobi and Lagos, we've got you covered. Here's what's coming up. Millions fear losing out on health insurance in South Africa as new regulations come into force. Ethiopia's way of improving food production. We'll be looking at this 3 decades after its worst ever famine. And we'll be also looking at Jumia. It's an online marketplace that aims to be Africa's Amazon. Let us begin in South Africa, where the government there is planning to further regulate the medical health industry. Now, under the Medical Demarcation Act, the industry is split between medical aid and medical insurance. Now, under the new draft regulations pertaining to that law, the government wants to limit the number of insurance products on offer so that more people can take up comprehensive medical aid cover. However, the thing is, a lot of South Africans simply can't afford what's on offer. There's growing concern that soon millions of South Africans will simply have no medical cover at all. Here's Sumitra Naidu with more.
Comprehensive medical aid cover has become a luxury that millions in South Africa can't afford. As a result, many opt for alternative health insurance products that are less expensive. These offerings are usually cheaper, and with a wide variety of products available on the market, South Africans can narrow down their choices for their specific needs. So, for example, if one is concerned about healthcare, they can choose a product that caters for hospital expenses, or they could take out a product that pays them cash for each day they stay in the hospital.
At little cost as 250 Rand a month or 350 Rand a month can give you the option for primary healthcare to go into a private doctor network, make an appointment with a doctor, go and see a GP, get some prescribed medicine, go and see a dentist, go and get x-rays if you need to get x-rays. But these are all primary products, so it's not in-hospital care.
But government is concerned that these insurance products are limited in what they provide and that people are covered better with a medical aid. The National Treasury says the amendments to the Medical Demarcation Act addresses these issues.
We're trying to actually ensure that that we have level playing fields between these environments, and we don't undermine the medical schemes vehicle, which is actually the primary vehicle for healthcare coverage and comprehensive coverage in the country.
Under the new regulations, most insurance products don't qualify and will have to be discontinued, and the amounts of cash payout plans will be reduced.
A lot of people that can't be on a medical aid opts for health insurance products. And if the demarcation regulations are passed in their current form, it means a lot of these products will fall away and people that can't afford medical aids will be left with no other alternative.
The medical aids industry has welcomed the proposed changes. The industry operates on principles of cross-subsidization, which means that young and healthy members cover the costs for the sick and elderly. Medical aid companies believe the growing insurance market is luring this younger market away from comprehensive medical aid cover.
If these schemes lose their young and healthy members, because people now have a way to just select out the young and healthy members, it means that the most vulnerable people who have paid medical scheme premiums for 40 years, all of a sudden their cover becomes a lot more expensive.
But the issue remains affordability. According to a private sector study, only 17% of South Africans have medical aid. Public health care is only free to those who earn less than $600 a month. The rest have to pay for health services, and the concern now is that these products will no longer be available.
Once the regulations take effect, those product providers who actually want to continue will be migrated into the medical schemes environment and can continue offering their products under a special dispensation, a relaxed Medical Schemes Act framework. That will kind of address some of the affordability issues.
The new regulations could be passed into law later this year. Most South Africans are unaware of the changes and may soon find themselves without any medical cover or having to pay up more to get a medical aid. Sumitra Naidu, CCTV, Johannesburg.
Elsewhere, Ghana's President John Dramani Mahama says the country project to supply gas from its offshore Jubilee oil field will start production by the end of the year. The $850 million project was supposed to have opened in December last year, but it stalled due to difficulties in securing the disbursement of about $600 million from the Chinese Development Bank. As a result, Mahama's government has struggled to tackle the country's energy supply deficit, and it has spent more money than its budget projections on oil imports. The Western Corridor Gas Infrastructure Development Project includes a 111-kilometre pipeline in the western region that will take gas through Atuabo to thermal turbines at Abuadze, run by the Volta River Authority, that will generate about 500 megawatts of power.
Some gas will start flowing, but actual commissioning will be when the full volume of about 120 million cubic feet is being transmitted to Abuadze. And I suppose that should be sometime before the end of the year.
It's going to help to stabilize the supply of power. We're going to have a reliable, uninterrupted supply of gas to VRA. And so VRA will be able to give us uninterrupted, reliable supply of power. And that is good for industry and also for domestic users.
Now then, let's get a little more detail on Ghana as a whole from an external perspective. Melanie Ralph is live in London. She's got more details on this story. And Melanie, once this project, delayed as it is, does come online, to what extent will it help Ghana's economy get back on its feet?
Well, Emma, because of the delays, it has meant that Ghana have had to splash the cash on importing oil, something that's caused the fiscal deficit to balloon. It's not just the cost of the oil, but other costs that come with it, such as duties and foreign exchange differences. We know that a sharply falling currency has been a big factor leading to Ghana's fiscal problems, so importing energy is an expensive business for them. No doubt, the sooner the gas can start flowing at proper capacity, Ghana will have the chance to claw back some of the losses.
Indeed. Speaking about other things coming from Ghana, it's tapping international debt markets once again. What more do we know about the pricing and the issue of Ghana's latest $1 billion Eurobond?
Well, Ghana is looking to raise money and it's sought the help of Barclays, Deutsche Bank and Standard Chartered. They're currently involved in investor meetings across Europe, then on to the US in the next few days. And some reports suggest money raised could include refinancing of an existing 2017 bond via a swap. Certainly markets will be keeping a close eye at how successful Ghana is with this to gauge the financial appetite for emerging market debt. With the gas project coming on well, we might very well see a few investors wanting in on the action.
Indeed, but past Eurobonds from Ghana have been oversubscribed. But is there concern from the market that this time round Ghana may be taking on too much, maybe too expensive debt?
Yeah, we know Ghana is highly reliant on exporting commodities such as gold, oil and cocoa, so which can equate to a very volatile export price, of course. Throw cheap debt into the mix and it could be a recipe for disaster. Do the math slightly wrong and the fiscal problems increase, equating to stagnation and a falling currency. The biggest worry to markets are fiscal problems leading to debt default, of course, and hopefully Ghana has learnt from past fiscal faux pas that with an end in sight to the gas project, not to mention possible backing from the IMF, yield-hungry investors might very well want in.
Indeed. Finally, Melanie, there's been quite a bit of speculation about exactly what the IMF will recommend to Ghana once talks between the two parties start on the 16th of September. But beyond fiscal consolidation, especially on the public wage bill, what else do economists expect talks between these two parties to focus on?
Having the right policies will be the top of the agenda, as it always is with the IMF. Details that will be ironed out will be the length of the programme, whether it be 2 or 3 years. They're meeting mid-month, as you said, and possibly have an agreement in place by November. Fiscal tightening will be inevitable for Ghana. Subsidies, public sector pay and borrowing will all be scrutinised. So the tug of war begins with Ghana desperately trying to prevent too much fiscal tightening demands by the IMF. So expect to hear some more on this in the coming weeks.
Indeed, we'll certainly be keeping a close eye on that story. Thank you very much for that. That's Melanie Ralph live in London. Let's take you to another oil producer, an emerging one as well. In East Africa, Uganda is in the final stages of bringing on board more international investors to explore for oil and gas in the country. 3 multinationals, Tullow, Total and CNOOC from China, already operating in the country, and now the East African nation is seeking to engage more to exploit the estimated 6.5 billion barrels of oil reserves. Here's Michael Balekia with more.
Uganda's energy ministry says only 40% of the oil-rich Albertine Rift Basin has been explored. Uganda says that an area straddling its border with the Democratic Republic of Congo has already been marked and started to facilitate exploration of the remaining 60%.
We are making arrangements to bring on board more investors who are coming to do exploration, and we are making the necessary preparations so that we can have competition through bidding rounds.
Out of the current 6.5 billion barrels in reserves, Uganda's estimated recoverable oil stands at 1.4 billion barrels. The East African country is now banking on oil companies having the capacity to effectively exploit these petroleum resources to really boost its economy.
We are striving to ensure that the investors who are coming in, that the oil companies get more efficient technology. It's now the technology that can maximize how much we can get out of this.
Ugandan officials also confirmed for the first time the existence of commercial natural gas deposits estimated to be around 500 billion cubic feet. Away from exploration activities, government says the proposed 60,000 barrel per day refinery will be built under a public-private partnership. The private investor will take a 60% share and also run the facility for about 25 years, while government of Uganda will take a 40% share. But production has been repeatedly delayed over contractual disagreements, tax disputes, and infrastructure setbacks, and is now expected by 2017, according to Uganda government. Michael Baleke, CCTV, Kampala.
Right then, quick run through the equity markets here for you. Except for the JSE, Nigeria and Kenya both closed slightly higher at the end of trading today. Some highlights for you from East Africa. NIC Bank in Kenya did manage to successfully raise about 5 billion shillings, roughly $57 or so million in a bond, yield of about 12.5% on that. It's going to be financing expansion and a drive into a lot more lending. Expect, however, that it will come back to the markets for two reasons: $3 billion in more 3 billion shillings in more bonds to come, and on top of that, a rights issue as well. We'll keep tabs on that and keep you updated on what's coming up in the markets. When we return, we'll be looking at Ethiopia's ways of improving food production 3 decades after the worst famine it ever had. And we'll be looking at the changing times and tastes of East African car owners. Africa is on the move. It's home to 7 of the world's 10 fastest growing economies. We help you make sense of the fast changing African business landscape. We take you where the business is happening.
The rebasing of Nigeria's GDP has been a long time in coming.
The information provides us much more scope to know what the structure of the economy is.
Hello there, welcome back to the program. You're watching Global Business Africa. Now then, with respect to the question of President Robert Gabriel Mugabe's trip to China and whether or not that actually paid any dividends, well, some would argue it certainly seems to be doing so. This comes after a multi-million-dollar hydropower plant was commissioned on Thursday this week. The project's cost is over $500 million. $320 million of that was provided by the Chinese government, which has also committed itself to assisting Zimbabwe in setting up special economic zones. Here's Farai Makutuya with more.
The power station is expected to generate an additional 300 million megawatts of electricity. A dream come true for the country that's been suffering power shortages that have led to regular outages and affected economic recovery. It's just one of at least 9 major infrastructure projects that China has committed to help with as it plans on consolidating its partnership.
Zimbabwe ranked first in Africa to attract Chinese foreign direct investment in 2013, which reached $602 million US. and covered a wide range of areas, including agriculture, manufacturing, construction, mining, tourism, and so on. The trade volume in 2013 surpassed $1.1 billion, almost doubling that of 2010.
China has also pledged to help Zimbabwe set up special economic zones to revive industrial activity and boost exports. The Kariba South hydropower project has been on the cards for years now, but has failed to materialize as government has been struggling to raise the funds to implement it, as well as a variety of other challenges, which the country now hopes to put behind it.
I, however, would like to observe that implementation of public projects has in the past been characterized by inefficiency, delays, and lack of commitment, which cumulatively have often compromised the cost effectiveness of the projects.
Apart from power generation, Zimbabwe is also aiming to upgrade its transport and communications infrastructure, key enablers for economic growth. Farai Mwakutuya, CCTV, Harare, Zimbabwe.
Elsewhere, Ethiopia has embarked on a farming program to improve food security. It basically combines scientific knowledge with local know-how, community-based seed banks and training centers, all of which are helping farmers to meet basic needs and increase their output. On What's Hot tonight, to explore how farmers in the country are set to benefit from these plans.
3 decades after the famine that killed more than 1 million people in Ethiopia, the country's scientists and farmers are taking the fight against climate change and food insecurity down to the ground. The famine was a result of both natural and human causes, but scientists say even at the time of the crisis, they had identified multiple seed varieties do not adapt to change in weather conditions. In the past few years, community-based seed banks and training centers have been established to support farmers.
We give them training, how to produce. For example, this is a hybrid seed and it requires some pre-question, and so we give training to them. So basically, the things we provide to these private seed companies: training, enhancing their capacity to produce seeds, and also initial seeds.
Ato Alemayu Makonnen runs a farm that produces hybrid maize, wheat, haricot beans and teff seeds, which he supplies to local farmers. The farm is fully mechanized and uses new technology. Makonnen received funding for this project from the Alliance for Green Revolution in Africa, an independent Africa-based organization working with small-scale farmers across the continent.
The demand is so huge, but the supply is limited because there are no many seed companies who are capable to produce quality seed for maize, wheat, beans, and other cereal crops.
At this year's Africa Green Revolution Forum in Addis Ababa, emphasis was made on using technology to boost agriculture output in the continent.
We must end the era of prodigal economics, where Africa ignores its own agricultural potential and turns itself into a net food importing region, spending a whopping $35 billion annually on food imports. Yet, 65% of all the available arable land that will feed 9 billion people in our world by 2050, it's not in Latin America, it's not in Asia, it's not in Europe, it lies right here in Africa.
For instance, if you look at the multinationals, they only focus on particular crops like maize. And yet in Africa, our farmers grow a wide range of crops. So it is these small seed companies or local seed companies who are interested in producing seed of those other varieties which the multinationals don't touch.
Ethiopia's seed bank beneficiaries are some of the success stories in Africa. In less than a decade, the country has emerged from a famine-ravaged economy to become the 5th largest in Africa. Growth has been driven by an expansion in services and, most important, agriculture. Noel Makugu, CCTV.
Now then, for decades in Kenya, the brand Mercedes was synonymous with luxury. If you want proof of that, You don't have to look any further than the fact that the official car for every Kenyan president since independence to date has been a Merc, and that's still the case today. Things, however, are changing. On the 3rd of September, Porsche opened up its first dealer for Eastern and Central Africa, having sold 18 units in their brief time here, and that came months after Jaguar's entry. Now, between establishment players like Mercedes, how exactly can Jaguar carve a niche for itself? That's where my conversation with Sanjeev Shah, Managing Director of RMA Kenya, began.
Mercedes has been an established player all over the world. Indeed, there is even an expression, wabenzi. So you're successful, you buy a Mercedes. You know, that kind of ticks all the boxes. So they're enjoying their volumes, and they have kind of sat at the similar sort of volumes over many, many years for Kenya, for our marketplace. Jaguar we just spoke about, you know, I mean, there's every reason why that, with that heritage and with what Jaguar represents, why it shouldn't be here. Thus we're bringing it into, and we've brought it into Kenya. And now Porsche's crept up. So we'll come to that in a minute, but there is slack in the market, and we're all finding our volumes. There is no such thing as a bad car in today's market. You know, everybody is right up there with their quality. So what it comes down to is what the brand represents and how it presents itself. Jaguar is British. It's very British in its execution. Look at the beautiful curves, the lines, gorgeous from any angle. The inside, it's bespoke, double-stitched saddle leather, etc., etc., etc. People buy cars for love and passion. They don't buy cars. Cars are not an investment. So yes, you've got to have a degree of logic and understanding as to what your requirements and the hard clinical numerics. But what we've done is we've combined the fact that Jaguar, with its heritage, its design, brings the passion out in anyone that looks at a Jaguar, and we put the hard numbers together and made it a better value proposition.
Did you enjoy that?
Well, if it wasn't for the fact that you have to go back to the office, I'd probably say one more time.
What a racket, huh?
It's beautiful.
Look, Porsche is a sport brand. It's always been known as a sports car. The classic 911, that's what it's known as, the Porsche 911. They did a good job of the Cayenne, and they're bringing out the Macan. But we established the SUV marketplace back in the 70s. We've got a longer heritage. We, with the Range Rover Sport and with the Range Rover Evoque, we've got some very, very sporty SUVs. And in fact, if you go for outright performance, we're right on the nail. We're right next to Porsche, if not above, in performance terms. Depends which engine variant you compare. But you know, our cars were developed off-road. Our heritage is from off-road. Porsche came from on-road to off-road. We believe that in our market, we're better suited for our roads than Porsche.
We certainly do live in interesting times in East Africa. Let's move on to commodities here for you. Oil prices dropping partly because of demand jitters as it emerged from the American jobs data that came out today. Well under 200,000 jobs created by the American economy. However, with regard to other commodities that are more pertinent, certainly to the African continent, Cameroon's output of cocoa is down about 8% in the 2013-2014 growing season, just over 209,000 tons of the commodity. Prices, however, not that bad actually, just about $3,000 a ton, and that's close relatively to a 3-year high. Coming up on the program, we'll focus on Jumuiya, the online marketplace that aims to be Africa's Amazon. Now, we just focused on $100,000 cars. Let's talk about something a little more affordable here. The online retailer Jumia recently launched in Cameroon. That effectively brings its footprint to 8 countries across Africa. It's part of a new wave of interest from European investors in businesses that deliberately target African consumers. On Grassroots tonight, Iris Spiter has this report on a growing online shopping business that is banking on Africa's growing middle class.
Online marketplace Jumia has been called the would-be African Amazon, and they're betting big on e-commerce in Africa.
The online e-commerce is doing the same thing that happened with mobile phone and fixed lines, which is that online is leapfrogging traditional offline.
Jumia launched in Nigeria in 2012 and now operates in 8 countries, offering delivery of over 100,000 products in 1 to 5 days. They've focused on building a delivery infrastructure, which they see as the main barrier to entry on the continent. They've also had to tweak the traditional model for local sensibilities, for instance, allowing customers to pay after they've inspected the product. With the emergence of Africa's middle class, the rewards could be huge.
There will never be the same footprint of traditional stores as in the US or in Europe. So imagine a place where you will never have a Zara, an H&M, a Mango at every street corner. People will still look for clothes.
The United States signaled their interest in doing more business on the continent at the recent Africa Summit. Europeans want to make sure that they don't miss out.
For direct investment, Africa currently offers the best returns worldwide. The political stability in Africa has increased. The economic growth has been very constant for many years.
There has traditionally been a lot of investment in infrastructures, in oil and gas, and raw materials, and this has always happened in Africa. I think you see more and more people investing into consumer goods, in mass market companies, basically.
Jumia says they're doing several thousand orders a day and growing by double digits month over month.
Jumia definitely has the first mover advantage, as global players like Amazon and Tmall have yet to significantly invest in African operations. With increased interest from here in Europe and elsewhere, though, that could soon change. Ira Spitzer, CCTV, Berlin.
Right, then a quick run through the currencies here for you. The Kenyan shilling, pretty steady in trading today, getting quite a bit of support from the vampire effect, if you will, from central bank repo operations. The rand in South Africa, relatively steady. It actually did rise. Expect pressure next week, however, from a wider current account deficit. We'll get confirmation of that coming through from central bank data on Tuesday. That's it from this edition of Global Business, however. Do remember you can send your feedback on the program to globalbusinessafrica@cctv.com. Check us out online as well, Facebook and Twitter. Wherever you are, so are we. Stay in touch with the program. Thank you for watching. Sports is up next with Mahia Mutua on Matchpoint.